Back on Morning Mover. Second quarter earnings season kicks off in earnest on Tuesday when the big banks start reporting their results. JPMorgan Chase, the nation's biggest bank, is the headliner. A second quarter adjusted EPS expected to come in at $4.51 a share on revenue of nearly $44 billion. Keep in mind, the bank hit an all-time high last Thursday. It's up 20% so far this year. Time now for Options Corner. Joining us to take a deeper look at JPM is Rick Ducat, lead market technician. All right, Rick, let's talk about the trends that you notice when it comes to this chart.
For sure, and Kevin Hanks had said earlier, there seems to be a concern that these big banks have rallied too far, too fast. You can see that JPM handily outperforming the S&P and the financial sector, up about 43% since those April lows. To look at the chart, though, we can see that, there's some clear areas of interest here. The 280 level, this green line here, represents these old highs, breakout point, and a retest. So JPM, despite pulling back a bit recently, has held on to this important prior support level. We are above our moving averages. RSI is maintaining its upward trend line as well here. Volume nodes here and here and here match up with 290, 275, and about 265 to 270 or so. Those are some key technical levels.
Those are some key technical levels. All right, what stands out to you when it comes to recent open interest or volume?
Sure, and the 280 level is what I really want to highlight here. If we're looking at the monthly expiration for next week where JPM has earnings, expected move, the shaded area, 275 to 300. The option open interest activity is the highest on the call side, 280, as we mentioned earlier, 290 and 300. Our put activity also highest near 280, 250, and 230. So really an important level for the market to hold here. Very heavy options trading around these levels. Very heavy volume as well yesterday in the January and March expirations here, as well as just what you would expect for the next 2 weeks of expirations.
All right. Thank you, Rick. Appreciate the look across the chart for JPMorgan Chase. All right. Time now for an example trade. We've got Tom White, senior options contributor and co-host of Fast Market. All right, Tom, what's the approach for an example trade given JPM kicks off earnings in earnest next week?
Yeah, this is another one of those names that, technically, as Rick put it, maybe it's overbought a little bit just because of the rally that we've had from those April lows to all-time highs last week. That's a concern, I think, for a lot of traders and investors out there. The optimism's pretty robust across the board, especially on some of these financials. Now, is the economy improving? That's going to actually support that. So I looked at a strategy. If you think this thing is going to continue, maybe go back to those all-time highs that we saw last Thursday, this strategy takes advantage of it. The option market pricing in about a plus or minus 3% move in the shares. Either way, about 850 on a one-day move post earnings that come on Tuesday morning. So take that into consideration. Implied volatility levels, while elevated, typically in the financials, we don't have big outsized moves expected by the option market. They're relatively, conservative at this point. So looked at a bullish call diagonal here where I can take advantage of implied volatility levels between the different option series. Really short-term positioning. Buying the July 25th weekly options. Those expire in 14 days. We're going to buy the 285 strike call. Against that, we're going to sell the near-term July 18th options that has that earnings event. We're going to sell the 295 strike call. So a bullish $10 wide call diagonal to the upside. You're going to pay roughly about a $5 debit. So you're paying about half the width of this bullish call diagonal. That's good, right? Why is that? Well, because you're buying a lower implied volatility in that July 25th 285 strike call. It's about a 28, 29% implied volatility levels, while in the near term, July 18th on that 295 strike call, you're selling about a 36, 37% implied volatility on aggregate. Break even on this one, about 287. Anything above that's going to be profitability on this trade. You're taking advantage of that vol dispersion between the two, but you definitely need the stock to move a little bit higher. Apex of profitability at or near that 295 strike, but anything above about 287 is going to be profitability on this one. And if you don't like this and you're more bearish, it's about the strategy. Do maybe a put diagonal to the downside where you could buy July 25th 285 put, sell the 275 put in the near term July 18th. So you can flip-flop this type of strategy. You're just trying to take advantage of vol levels. You have to pick the direction. This is a bullish example.
All right. Thank you, Tom, for that example trade, leaving us with a 2-for-1. That's our Tom White, co-host of Fast Market.